Hey traders, welcome to Charts and Coffee. Great to see everybody. Happy Monday morning. We're taking a look at really what has happened since the Asian session where there was some mild risk appetite. And actually, let me show you what I look at first thing in the morning here. I'm going to move the daily chart aside here. Here we go. All right. Here we go. So if we have, this is the Asian close, by the way. So at 4 a.m., take a look at the way in which the Asian session closed. And remember, this is overlapping with the European and UK session, which had opened 1 and 2 hours prior. So we kind of have been meandering around, but we really haven't taken out some of those Asian session closing lows. In fact, we haven't even taken out the pre-market lows about 45 minutes after the London Open. So you can see there, 345 punch down on, say, crude oil, which is a position that I have open right now, down to 81.90, and we're moving up higher from there. Cool. As long as they're staying above about $82 a barrel, next stop is retesting that resistance at 82.50. So whatever it is, let's do the same thing with the S&P. First thing in the morning, again, what am I looking at? How was it that we behaved from about 2 a.m. to 4 a.m.? What was sort of that closing Asian session opinion? What were the lows that we punched down to during the European and UK session? You can go back to see what the lows were during the heart of the Asian session around 8 p.m. Sunday. But you can see here for most of that time, from 8 p.m. Sunday forward, we have been climbing. And so now the challenge is, can we stay above, say, some near-term support on the open? I'd really like to see for this uptrend to regain its strength, price stay above at 56.80. But the real challenge waits above, not at 56.94. That's really the next hurdle is 5,700. And based on the uptrend on the daily, if someone were to say, Rog, what are the chances that we pull back to, say, 55 or even 56 or going to 57? In the case of an uptrend, like we have in the daily time frame of the ES, the main thing that could derail this for now would be the financial earnings that we've got coming up, because financials are weighted number 2 in the S&P. And by the way, they're number 1 in the Dow. So if you're watching the Dow play some catch up, it's going to be on the back of strength in crude oil, which could eventually rise the tide on energy stocks. And it's going to be on the back of what was generally pretty good data. JP Morgan held its own after earnings. It's Wells Fargo that gapped down about $4, which is not a small gap considering it was about a $60 stock at the time, but it's not really going any lower than some of the lows you can see here that we saw back at the end of June. So not bullish, of course, and those 4 points will be a little bit of a drag on the average, but for the most part, financials are doing pretty well, and that's feeding the overall strength in the Dow. And that's where we sit. Again, we want to focus on the data. We want to focus on the price reactions. We want to focus on the volume we're seeing at different levels. And for the most part, again, here we are Monday morning. We'll see what we look like after the clearing period, but here we are up and away. And this is definitely feeding the trend that's already in place, right? Why is the trend in place? Because the Federal Reserve is going to cut rates. Ultimately, trends tend to, even after a pullback, continue, which is why buy the dip often made fun of, but that's why it works. Continuation is likely the probability after pullbacks in the context of a trend. So does that mean every dip is buyable? No, because not every time frame is in a trend. So remember, structure dictates strategy, and right now we're going to continue to be on the long side, putting my money where my mouth is. Yes, we've been continuing to buy things like the NASDAQ, XLK. We're looking at those trends that are already heading higher. And when those dips come, we're engaging them. And that's really it. I'd like the NASDAQ to get with the program a little bit more, but it does seem that financials and energy might be a lot of where the new attention is. As we wrapped up last week, believe it or not, home builders, regional banks, GDX, gold miners, XME, metals and mining, those were leading the charge the last 5 days. So remember, building a watch list is not about the 17,000th conversation about SMCI, right? I mean, are people really still talking about this thing? SMCI had a really good Q1. Watch list building. Here's the difference. This is such a great example. Watch list building is the difference between keeping an eye on something like SMCI between January and the beginning of March, and then realizing it hasn't done squat ever since. But a lot of times, kind of going back and saying, well, but the glory days, maybe this does break out again. I would be more leaning towards a potential breakout. But please remember, a watch list is really what's happening now. Where is the structure now? Not where was the structure, and how can we take advantage of what already happened 3 months ago, right? And I think that's where a lot of traders get stuck. They get stuck in old narratives. They get stuck in old stories that are not playing out now. We trade in the now. We get paid in the now. We manage risk in the now, right? So those are things to keep an eye on. All right. So let's see. Yeah, exactly. Good morning and good watch list building. Absolutely. Gang, 80% of what we should be doing as traders is building a watch list. What are those symbols that have the best probability for following through? Not, how do I trade my favorite stock this morning? Or what meme stock, or what's gapping, or what's being talked about on television, which 90% of the time I have off. So what's happening now? Where is the strength now? And where could we expect continuation, follow through, right? Fills get us in, but follow through pays us. So question here is, I'm long, hey there, Fernando. I am long Berkshire. Cool, from 3 sessions ago. Get a nice breakout, target 434. Want to know my take. So my take is really simple. Anytime we have a breakout, most of the time, not all the time, but most of the time, and I mean the vast majority of the time, we're going to have some sort of consolidation or congestion that precedes it. But because before something has a momentum breakout, what is it breaking out of, right? So in this case, boom and boom. Look how long that was in place. All right, so cut it in half like a sandwich, and this is how I would look at this. This is the zone that you want to build the long position in, the lower half of the lower quarter, as close to the support level as possible. This is the breakout level through resistance right here, right? So now I'll look to this next resistance level up in there. And the other thing I would do, and that's going to be about 430. The next thing I would do, and if you have it, get comfortable with looking at here we go. Get comfortable looking at TradingView and the here we go, daily time frame and the volume profile. Is there any volume in play up at these heights? Not much. Let's squeeze in the previous quarter. So you might not have a lot in your way towards 430, my friend, and I would keep an eye on that. There doesn't seem to be a lot by way of size in your way, but there is the high that we can see from February 26th in your way. And not so coincidentally, from a volume perspective, 432.5 would be another level that I would keep an eye on. Now, I'm sure that you have some kind of calculation as to why 434, and I certainly don't want to override or undermine that, but this is what I've got on my chart. So we've got resistance at the previous February 26th. We've got some V-score resistance as we close in on, say, that level there, 432.5. And then, I would actually set my sights on about 447. I would set my sights on 447 for Berkshire if this breakout can organize into a trend, or at least keep the bullish momentum going, which you can see is right there. Okay. So let what you see, let your charts, like a map, right? Let it be your guide, and then we'll go from there. So yeah, as far as going into earnings, which are on the 29th of the month, you've got about 2 weeks. So I would say, regardless of what level is reached, Fernando, within the next 2 weeks, that would be where I would want to at least have scaled out a little bit, move to break even. And then for me, I want to be flat through earnings. But if you want to then keep a smaller position where you've already realized a profit, so you've got this profit cushion, and then see, okay, what could I do with earnings? That's not a bad way to go either, where you would take advantage of the momentum into earnings, pay yourself, keep a little bit of that position on because you've only scaled out, not gotten out, and then see how much higher is high. All right, next up is CRWD. This has been getting a lot of chatter lately. It's been moving, not pretty, but generally higher. And it's been, I'd say, since the end of May and through much of June, and then a little bit in July. It's got this kind of back and forth, trending, then chop, trending and chop. I would stay bullish here. I would absolutely focus on the long side. No reason not to. If you're looking for an oversold buy, you want to look at something like what we saw back on June 3 to June 4, where the trend basically wobbled a bit. I didn't say, it's not as if the uptrend broken, it's a downtrend, right? An uptrend broken is bullish chop. So you take a look at maybe an oversold level. That might be the way to go here now, but it's teetering on still being a trend. So we're in a mean reversion zone. In fact, that level that we reached right around 368 would be considered the moderate zone of that mean reversion. So I have an aggressive zone, a moderate, and a conservative zone of that mean reversion. And you can definitely see that in play on CRWD, which I would treat still largely as a trend. 1A, I would absolutely treat that still as a trend and focus on that. Now, earnings on CRWD are not till the end of August, right? So you've got plenty of time. If we are, in fact, going to have a rally into earnings, would not be a bad thing to keep an eye on. All right, next up is Google. Sure. All right, taking a look at Google. This is a trend. This is straight up a trend, and it's been that way since the 21st of June. So as long as I have a trend in play, buy the dip. That is, that structure dictates strategy. This is bullish structure. It's an uptrend. I don't focus on overbought or oversold in a trend because remember, any trend is inherently imbalance. Any trend is inherently a probability of higher highs and higher lows, more support than resistance, more demand than supply, whatever the verbiage is you want to use. So I would continue to focus on buy the dip on Google. And the only challenge really here is we've got earnings in 7 days. So either I would say with a 7-day to earnings window, I would turn this into a short-term 1 hour focus for the swing where I could have a window of more than around 1 to 3 days. And I don't need much more than that for risk management and follow through. Now, granted, if you want to go with the daily, that's cool, but I would want to be out flat, closing the position before earnings. I do not like to take open positions into earnings. It's a coin flip. It's a guess at best. The cleanest action you will get into earnings, right, is that either rally or sell off into it. I prefer the rally. So the clarity is going to be really best, usually 6 to 2 weeks before earnings. And inside 2 weeks, the implied volatility starts to increase. The volatility itself starts to increase. So be a little careful, but we're what, about a week out from earnings. It's going to be on the 23rd after the bell. So keep an eye on that. But yeah, one short-term swing may not be a bad idea. All right, next up is NET for a long position. All right, let's see what we've got here. All right, NET. Let's open up the daily. Overall in an uptrend, not too far from the mean reversion. However, 2 levels to really keep an eye on. If we were to go down to 77.25, I would have no issue with that. But really, I would keep an eye on 80. I would keep an eye on 80. And the difference, and here's a great example of the difference between waiting for a breakout, which I do not do, and thinking about a trade in sort of a stage 1 and stage 2 approach. So for those who say, Rag, do you play breakouts? Are there breakouts in your process? Yes, but it's always stage 2. In other words, stage 1 is, even in the context of a trend, is there a range that's formed? So notice I do this automatically, right? I automate my indicators. I don't want to automate anything else, but I want to automate my indicators so there's no emotional attachment, bias, putting lines that I want to see so they agree with my overall take, right? My indicators don't give a rip what I want to do. It just is meeting the criteria or isn't. So now I can say, all right, something unemotional, unbiased has said this is the range. As close as I can be to the support would be great. If you want to cut the range in half, go with the lower half of the lower quarter, great. Now, here's the thing. What you can then do is, let's say you're buying your calls in this area, right? This gives you an opportunity to pay yourself here, and then that's stage one. Stage two then becomes, can we keep going through this level and see some Momo follow through? But that's stage two, and I'm not going to enter up in this area. No way, no how. I don't hate my money, right? I'll enter in the lower part of the range, take advantage of just traversing the range, and then stage two becomes the momentum. And if you've never thought about your momentum breakouts like this, whether you're using the Darvis, whether you're using some sort of consolidation approach, whether you're using the squeeze, this is the best way to do it, period. Because what it does is it allows you to manage risk in a much more effective way. And it allows you to take profit at a level where momentum traders are just getting in. And you're able to say, you know what? Cool. I was able to get to that level. And now stage two, the follow through, right, will be the follow through because we've scaled out, not gotten out, right? Keep that in mind. Scaling and scaling out can be really powerful when you think about trades in different stages, different waves of participation coming in. All right. Thoughts on Microsoft? And it doesn't matter if it's NET or anything else. It's got a consolidation type pattern. Microsoft straight up by the dip. We're long XLK, Tyler. So, look, once you're in a position, there's going to be some emotion attached to it, right? So we're long XLK, which is to say I'm right there with you. I like Microsoft. We bought the pullback from last week. And so now we're just waiting for the follow through. Rather than going with the individual stock, sometimes if I like enough of the heavily weighted names in a sector, the bang for my buck becomes, can I buy Microsoft and Apple and NVIDIA and, or can I just buy the bundle, right? We're always told, bundle your services. This is kind of the bundle of all those. So rather than buying a bunch of individual names, I can buy XLK, which is the number one weighted sector in the S&P, the number one weighted sector in the NAS, and it has Microsoft, Apple, NVIDIA all weighted within it. So I like Microsoft, but Tyler, the way that I chose to do it was to go with the XLK, but pretty much the same idea. CELH, I'm looking long-term calls expiring in January. I can't do it yet. Christine B, I can't until we get above the 200. I can't until we shake off the downtrend. One thing I will tell you from a long-term perspective, we are sitting at a first standard deviation support level around this 60 to 55 area. It's on a level that I would buy, but I would keep an eye on that you really don't want to see lower lows below, say, 52, 51.80 if you are thinking to the long side. I can't do it on the daily, but long-term to me is a weekly conversation. So keep an eye on that area around 55. You don't want to see it slip below 51.80, but I can't quite yet on a daily time frame because it's still in a downtrend. All right. Next up is, I think that's it. All right, gang. Actually, I'm pretty much out of time. Kyle, I saw your question there. I'm not going to comment because it's just, and I appreciate it. So I would, if you have any questions about that, definitely ask John. Yeah, a lot of folks ask, Rug, what do you think of somebody else's? I don't pay any attention, to be quite frank. I just don't. I know what my process is. I know where I want me to be a part of the process. And as a general rule, I don't like to remove the discretion from trading because I really don't think a machine does it better, right? I don't think a machine's going to understand hot zones. It's not factored in. It's not going to understand time of day. It's not factored in. So, for me, it's just a non-starter. But I would definitely say if there's something you're curious about, ask that person. I'm sure they've tested it. That's what we do in our room. We rigorously test things for at least a year before we present something, because then we've got the data. We've seen multiple seasons and behaviors of the market. So since I don't have that data, I really shouldn't comment, but it's not my, it's not going to be my path through the market personally. All right, gang, as always, be good to each other. I'll see you tomorrow, same time, same station. Until then.